Good morning, viewers, and welcome to the channel. My name is Shannon Rifkin, and this week's video: what does the emergence of the Omicron variant mean for global markets? Look, we're still kind of in that early point, and we're expecting to have a lot more data on the Omicron variant over the next 2 weeks or so. But really, what you're considering the market over the last 2 years or so has kind of gone from that panic phase in the early days to certainly the point where vaccines showed incredible success in clinical trials, and now we've kind of gotten through to that point where vaccines have been well distributed over the world, and economies have largely reopened, borders are reopening, inflation has started to emerge, and now we've gotten to this point where if the Omicron variant, is as concerning as the first reports suggest, that is that it's incredibly infectious, could possibly escape vaccines, and is as highly virulent, or at least as much as other strains like Delta, and then could we, at least while we await new vaccines from the mRNA producers such as Moderna and BioNTech, which is Pfizer's partner, could we be facing new lockdowns, etc., and what would this mean? So obviously, if in the next 2 weeks, if it emerges, and certainly the early anecdotal data anecdotal stories suggest that it might be a milder version of the variant, which would be great. And I expect in that situation we wouldn't be looking at any significant obstacles to the reopening theme. Borders should remain open, and economies should remain open. But if and in that event, of course, I think you'll start to see you'll see markets kind of resume their earlier trends, which was pricing for interest rate rises over time, possible inflation problems, and probably outperformance of value names relative to growth names. But in the absence of that, and I should have shown this because this was a good guide. In the absence of that, I think what you'll see is probably the same sort of playbook. This is kind of an original pandemic-related panic, followed by economic conditions which are very supportive of equities, and that's the important thing here. And by very supportive of equities, I mean continued quantitative easing, and unwinding the recent moves to taper that we've seen. And even this week, we've seen Jerome Powell talk about inflationary pressures being possibly more than transitory, and that possibly they should speed up their tapering. But of course, short of if we were to start to see lockdowns emerge again and demand impacted, while there could obviously continue to be supply chain bottlenecks causing some inflation, I think it's highly unlikely you'd see that tapering continue, or possibly, depending on how bad things got, possibly QE could be increased. Certainly, interest rate rises would likely be pushed out as expectations of inflation were pushed out as well. And this one as well, fiscal stimulus to support people as they're unable to work. It's been pretty demonstrated pretty clearly that as people are forced to stay at home and they've received this fiscal stimulus, there's been incredible pent-up demand that's unleashed pretty quickly once economies reopen, and I think it's likely you'd see that again. This key one, inflationary pressures easing significantly, which would push all of this out, and of course likely rotation back into the pandemic winners, which are stay-at-home stocks like Domino's, e-commerce companies, out of those recovery names like the financials and travel sectors, and this is the big one here, and return to favour of long-term growth stocks, because of course as long-term interest rates lower, and we obviously seen in this early panic, bonds being bought up strongly, and the 10-year US government bond yields dropping pretty significantly, you'll start to see the value of long-term cash flows increase, and that will therefore mean that the pricing of those growth stocks will improve, and we'll see higher multiples. That will obviously come at the expense of value stocks. This will be a rotation. It won't be new capital coming in. It'll be a rotation away from value stocks, such as financials, which have performed pretty well this year. Anyway, that is it. Thank you very much for tuning into the video, and if you like the video, click like and subscribe, and I'll be back with you for a new video next week.